I want to welcome Brandon Munro, who is the CEO of Bannerman Energy Limited, whose stock price is up over 120% in the last month alone. Welcome, Brandon.
Hey, Elliot. Thanks very much for having me on.
Absolutely. Welcome. So, the question that's burning on my mind is just what is going on in the uranium market, from your perspective, from the perspective of the CEO of a miner. What is going on? Why is the spot price skyrocketing? And why are stock prices skyrocketing?
Well, it's very easy to get caught up in the moment in the last few weeks, which, as you say, we've seen a lot of volatility. It's mainly to the upside, which is great for investors right now. But as a CEO, I think it's important to reflect on the last few years and what's got us here. And that might put in more context some of the more spectacular things that are happening in markets right now. So this is a journey that probably goes back 10 years. And I've been in the uranium sector since before then. What happened was we had a nuclear power industry, which was coasting along very well. It was the new nuclear renaissance. Nuclear was being recognized for its carbon-free, emissions-free, clean energy and how important that would need to be. It was in the early days where climate change was being fairly broadly recognized and adopted, and everything looked fantastic in this sector. And then we had Fukushima, which was a very small part of a very big earthquake and tsunami and natural disaster. And there were 18,000 lives lost as a result of the Great Tohoku earthquake and tsunami. And probably one of those will be at the Fukushima nuclear power station through a person whose life will be shortened because of radiation illness, an employee who heroically rushed in to avoid some damage at the plant. But the media got hold of it, and Greenpeace got hold of it, and other groups who built their funding platforms on anti-nuclear propaganda understood that this was a once-in-a-generational opportunity to create a lot of chaos in the nuclear industry. Now, what happened was there was knee-jerk reactions in Japan and Germany in particular, and the sum total of it is by the end of 2011, about 10% of the world's nuclear reactors had been switched off. Now, the way that supply had always worked in this industry is on long-term supply contracts. So the supply of uranium into the sector did not respond. And so for several years, we had mines continuing to deliver into quite healthy priced long-term contracts without pulling back, recognizing this hole that had built up in demand. And the interesting thing about uranium and nuclear power is, generally speaking, supply and demand is quite finely balanced because uranium is only used for one thing these days, which is powering nuclear power stations. And equally, it's an unsubstitutable fuel source for nuclear power. So therefore, there's only one source of demand and there's only one source of supply for nuclear power. So even when they get out of whack by maybe 10%, if that happens for several years, inventories were built up, and the utilities who were the recipients of these long-term contracts continued to buy and continued to build up more uranium than they wanted or needed. And of course, the price slid, and we saw it slide all the way down to a recent historical low of about $18 a pound in 2017, 2018. Now, it started to improve, but that critically low price had a number of effects on the market. And the biggest one is it eventually caused a sort of supply response that would otherwise have happened a lot earlier. Even at $30 a pound, a very substantial proportion of the world's uranium mines are unprofitable. And for a long time, they stayed in existence because they'd get a blend of the long-term prices, which were written in much more buoyant times, and whatever production they needed to sell at current prices. And as those long-term prices started to run off, they were exposed more to the unfavorable current prices. And eventually what happened is a number of those mines had to turn off. And there's a number of mines that are today on care and maintenance. So there's the background. So we found ourselves, even only a couple of months ago, in a situation where uranium was trading on the spot market at about $30 a pound. A large proportion of the world's current production was uneconomic there. Very, very few mines around the world were capable of coming into construction and into production at that price. And most of the new supply that was required would need an incentive price above $60 a pound, so more than double what the current price was. So there's the setup, and lots of great stuff happening in nuclear power going forward, but maybe we can come back to that. So now enter the Sprott Physical Uranium Trust, which is what everyone's talking about at the moment. So Sprott understood that there was a huge opportunity here, unsustainably low prices, very limited capability for the industry to create a supply response because of an underinvestment in new mine production and exploration and development. And so Sprott acquired Uranium Participation Corp, which was the very long-standing physical uranium investment vehicle that was set up in about 2006, thereabouts. They made a start with that. They made a couple of tweaks, which were very important to the way that the fund operated. And so what we have now is the Sprott Physical Uranium Trust, or SPUT, that's listed on TSX. It has trading units in both Canadian dollars and US dollars, and it has an at-the-market facility, meaning that they're issuing shares all day, every day, issuing units all day, every day, and immediately using that money to buy uranium. And in about 4 weeks, they've bought more than 7 million pounds of uranium at a run rate that is faster than uranium's being mined around the world. And in so doing, they've moved the uranium price from a bit over $30 up to about $45. So for the first 3 weeks of that, it was the sharpest 3-week upward move in uranium spot price in history. And we've seen that have a predictably inflating effect, or at least an accelerating effect on uranium equities, as you said. So there's the setup, there's what's happening. And as you say, there's a lot of people who are excited right now.
It's just bringing about so many questions, right? And I've talked to some people who think, just based on the momentum with the Sprott Physical Trust and the fact that the supply demand fundamentals, the deficit's just getting bigger at this point because of the trust. And just looking at the momentum, it could get somewhere to 70, all the way up to 100, because what's stopping it from doing that? Obviously, we don't know exactly where it's going to go, but do you think this move has legs? I mean, can it keep going?
Yeah, and it needs to keep going from here. So $45 uranium might sound terribly exciting to people who've been investing over the last few years, and they've seen it sort of between 18 and 30. And I've got to say, it's nice to see as a CEO of a uranium company, but that doesn't actually solve any of the industry's issues. There are only a couple of mines that would consider coming back from care and maintenance at $45, and I'd expect they would want to hold out for much better pricing. And in terms of new mines coming on, there's very few mines of any substantial scale that would come on at, as I say, anything under 60, if not 70, if not 80. So the price will need to keep going up. And even if Sprott disappeared tomorrow, it would still need to go up to start balancing supply and demand. As you said, there's a deficit at the moment. And to put that in a little bit of perspective, over the last couple of years, mine supply, when added to what's called secondary supply, still generates 20 million pounds less uranium than is consumed in making nuclear power around the world. So 20 million pounds against a consumption of about 175, 180 million pounds. So there's a very substantial deficit being run in the best of times in our industry right now. It was made worse during COVID when there was supply disruption in Canada and in Kazakhstan, and to a lesser extent in Namibia. And what the utilities have been doing for the last few years is drawing down their inventories that they built up after Fukushima. But those inventories are at historically normal levels. And now we've got spot competing for all of that available pounds. And so you've got a bunch of different competitive demand tensions that we expect to kick in from here that will drive the price higher. And what remains to be seen is, well, how much higher does it go?
Exactly. And like you're saying, the economic price has a floor of 60, and let's just say it moves past that. What do you expect to happen, as a CEO, in the industry once it gets over 60? Do you think all the dormant mines are just going to say, great, let's raise capital, maybe let's issue shares, and let's just start producing? And obviously it takes time. I don't know, you could let us know how long it would take to actually get to production once you decide to do that. But what do you envision happening once it gets over 60 and stays there?
So here's the interesting thing, Elliot, and it's a great question. A lot of people assume that the price is going to hit a certain number. And like most commodities industries around the world, there'll be this big supply response that will then bring it back into check and will achieve an equilibrium. And I'm not sure anyone really thinks that equilibrium's going to stick around at $45, but pick a number. Now, in uranium, it just doesn't work like that. And it won't work like that for quite some time. So even if tomorrow the mines that are on care and maintenance, their owners decided to bring them back on, well, first of all, Kazakh mining is running at supply discipline levels out to the end of 2023. They've made commitments to the London Stock Exchange to do that. So for them to change their levels of supply will be very difficult and complex and have ramifications for not only Kazatomprom, but a whole bunch of privatizations that the Kazakh government's looking to do from here. Then you turn to Cameco, the McArthur River mine, which is the largest uranium mine in the world. Even from the point where they start mobilizing to restart that mine, it's 14 months, according to their NI 43101 statements, before they're at full production. And to get to mobilization is not an easy thing. They'll have to hire people. It's been a few years now since it was turned off. So most of those people have drifted into other jobs, of course. Under the Nuclear Regulatory Commission in Canada, anyone who hasn't worked in the industry for a certain period of time needs to retrain to get their certificate to work at a uranium mine. That takes time. And then if you look at some of the other care and maintenance projects that could come back on, you look at, say, Langer Heinrich that Paladin Energy have got, that's going to take time as well to come back on. And it's not like we've got a whole bunch of projects waiting in the wings that are just ready to go to the bank, get money and start building. We haven't seen any level of long-term contracting outside of the incumbent producers. So there's still, at best, a process where those companies will need to obtain contracts, then go to finance, and then start building. And as I say, we know what's in the industry, and those mines that could come back on are fairly small when it comes to the impact that they could have on supply. So the summary of that, and this is where it's just so fascinating, is we've got a price that is literally going up before our very eyes at the moment, with no potential for a supply response in 1, possibly even 2 years, which is where people are really starting to dream. They're starting to say, well, where could this go, given that it's not going to get filled in that time and it's already running a deficit? So it's a really fascinating time to be in the industry.
Right. So this kind of rocket fuel up move could exist for quite some time, which is very, very exciting. So then I'd love to hear more about Bannerman. It's a pretty popular company. Can you just give us some background and talk about how you guys, like what kind of your plan is long-term, especially in light of this move?
So we've been at the wicket, we say in Australia, for a long time now. We've been focused on our Etango project in Namibia and focused on uranium and nuclear power since 2005. So we're one of the long incumbents. And in that time, we've done a huge amount of technical work to a very high quality. And as a result of all of that work, what we've got is a world-class resource endowment at Etango. So the Etango project, to get your head around it, it's a very conventional, relatively simple, but very large, open pit, conventionally mined heap leach operation. So it's as simple as it gets in uranium. The ore body's straightforward. It's just the one type of ore. It's very homogeneous. It's low grade, but it's very, very big, and it's got a very low stripping ratio. So we don't need to move a whole lot of dirt that we don't want to get to the dirt that we do want. And that gives it some real advantages. We're in Namibia, which is an absolute pleasure, and probably we'll come back to that. So the Etango project originally, and we're still on background here, originally we developed that as a giant-sized project with an output on average of 7.2 million pounds of uranium per annum, which would place it in the top 10 largest uranium mines in the world quite comfortably. And to give you a little bit of perspective, that's enough uranium to service 16 or 17 full-size gigawatt scale nuclear power reactors. So literally enough to power certain countries' nuclear power requirements. Now, that came with, of course, a decent sized capital cost. You can't build mines that massive without a lot of capital. And during the bear market, a lot of investors had some serious concerns about how do we deal with that capital, which was 793 million US, as a beaten up junior trying to survive and scrape by in a bear market. And when I came into this job in 2016, our market capitalization was about $20 million. So you can get where the problem lies.
Right.
Now, what we did and what I did with the team over the last few years is we said, well, do we really have to look at it being such a giant-sized project? It had some great attributes, and one of those is the ore body outcrops. In other words, the rock that we want sticks out of the ground at one part of the project. And after a lot of analysis and a lot of looking at this from different angles and in different ways, we realized that if we made the mine small enough, we could stay within a pit design that had a really low strip ratio. And that enabled a whole lot of other things. And so about a year ago, we released a scoping study for what we've called Etango 8. And the 8 means that it's 8 million tons processed through the processing plant, rather than 20, which was the giant-sized Etango. And at the beginning of last month, we released a PFS on that. The numbers are robust. The technical work is absolutely great because we did a DFS and a pilot plant on the giant size. So we've got this great database of all of this work that was done, all of this drilling that was done. And so therefore, we've got a really advanced project in Namibia with environmental approvals and all of the technical work that's already been done to a DFS or definitive level, but just at a bigger scale. So right now, the exciting bit is we're completing our DFS on Etango 8. We'll have that done about this time next year. And that's perfect timing as far as we can see for a market that's really starting to mature and evolve.
And then, so what do you see happening after the DFS is completed in about a year?
Yeah, so then it's on to marketing. By then we'll have already started that, of course, but we'll need to choose a financing path that either involves conventional financing with a conventional approach to marketing and securing long-term contracts. And that hasn't been done a lot in uranium, and that's one of the real constraints that this whole industry faces, not only underinvestment, but a lack of experience amongst the different finance houses. But at the right price, that'll certainly be available, and we're seeing that interest pick up, as you can imagine. But what's really interesting about our project is it's an enormous resource. So our mining reserve for Etango 8 is 60 million pounds, but that sits within a resource of almost 208 million pounds, plus satellite bodies that are within trucking distance that add additional pounds. So what that means is, although the mine life is 15 years at the moment, there's a very realistic scenario where you either expand the mine life or you increase the scale once we're in production and profitable. So Elliot, what that all adds up to is we think this is a very attractive project for offtake financing partners. And that can take a variety of different forms. So that would give us the alternative to a conventional financing via a banking syndicate.
You guys are capitalized to get through the DFS.
So maybe a little bit of color on that. As at 30 June, we had $12.5 million. We expect the DFS will cost $4 million, which is a really low number. The one thing I didn't say is Etango 8 still produces 3.5 million pounds per annum of uranium. So around these parts, we think it's kind of small because the alternative was so big. But in fact, it's still a really big mine. There's only a handful of mines at that scale that have got prospects of coming on in the next several years around the world. So it's still a big mine. We can do it cheap for 4 million, not because we're scrimping on consultants. We'll announce shortly the appointment of top shelf consultants, but because all the work's been done, the expensive stuff has already been done. And we're pretty frugal here. I'm pretty stingy on money. So we can make that cash balance last a long time.
So just, as investors look around the world thinking about where to invest, there are companies all over the place. Bannerman's in Namibia. Can you just speak a little bit to the jurisdictional potential risks and or not risks, and just what the area is like? Is it mining friendly?
Yeah, I love talking about Namibia, partly because I love Namibia and partly because there's still inevitably a whole lot of misconceptions about Africa. And I find that with investors who quite rightly are cautious about Africa. But the big mistake that many investors make is they treat Africa as one homogenous country, and it couldn't be more different. It's like comparing Canada to El Salvador. Yeah, sure, it's all sort of North and South America, but it's pretty different, right? So Namibia, the best way I can describe it is from the guidebooks. So Planet calls it Africa for Beginners. There's another guidebook that calls it Africa Light. And it's a country where I wouldn't hesitate to recommend someone do a self-drive, hire a car at the airport and drive around the place. And I've got lots of friends who've done that. I lived in Namibia for almost 6 years, and I've obviously been there a lot in the interim. So I know the country really well. I was there with my family, and in the whole time we were there, we didn't even have a car broken into. So really safe, stable, secure. It borders South Africa, but it's nothing like South Africa in terms of the personal security and so on. It's a very different country. So that's kind of what it's like. It's beautiful. It's got the second lowest population density in the world. And so many of the challenges that countries in Africa face, they just don't have that intensity when people are very spread out. So yeah, great place. It's got a good, strong mining code and a strong mining history since independence about 25 years ago. Good support. What's really interesting about Namibia for uranium is that uranium and diamonds are the two biggest contributors to Namibia's foreign earnings and foreign reserves and exports. So the country's been, in the last 40 or 50 years, effectively built largely on the back of uranium. And you go to Swakopmund, which is the local town close to our mine, and half of the infrastructure has been built by the Rossing uranium mine that Rio Tinto started in the 70s. So you just don't have that angst about uranium that you do in many, many places, including, resources-friendly place like Western Australia that ought to understand it better. So that generates community support, government support. In terms of risks, I think the biggest risk at the moment, which isn't so much to uranium mining, but to business in Namibia, is that the economy's really been hit hard by COVID. And they've had several lockdowns. The economy's now lost its resilience that it had. In conjunction with COVID, we had prolonged low uranium prices and a real dive in diamond prices. So the fiscus wasn't filling up like it could have. So the country in general, is really hurting from a financial point of view. It's had a lot of employment destruction because of COVID. Now that, of course, cuts both ways. And for a mine in a country that's got a development agenda, you would expect, and we think, will make our path even more important to the local economy, to the local fiscus, to government, to community, and so on. So we don't see that as a disadvantage. But, for someone who's got a lot of really close friends and who still has my soul residing in that country, it's really hard to see what's happening at the moment because of COVID.
Gotcha. And just a little off topic, isn't China investing heavily into Namibia? I feel like I've read that. Yeah.
China's invested quite heavily into Namibia. You read a lot about Chinese investment into Africa. You read a lot about it not always being on even terms. Now, what's an interesting observation about Chinese inbound investment into Namibia is that Namibia was the last African country to achieve independence. And that's a really interesting fact for a whole bunch of reasons, but we won't go into that. But they learned a lot of lessons from other African countries. And because they became independent because of a broad-based United Nations push to sever them from South Africa, Namibia's remained friends with everyone. So they're friends with China, they're friends with Russia, they're friends with the US, they're friends with Europe, they're friends with Australia and Canada. Now, that's really important, partly because they can sell uranium to anyone. And if we start to see geopolitics create a divide between the East and the Far East and the West, that's okay for Namibia because Namibia won't have to pick sides in that. But what it also means, to your question, is that because there's been a lot of supportive, competitive inbound investment from the great powers and economic centers around the world, they haven't been beholden to Chinese investment. So it's been balanced. So when China comes and invests in Namibia, they do it according to Namibia's rules. And that's what we've seen. So there's no stinky port deals. There's none of that sort of thing that you might read about or have allegations about in other African countries. And it doesn't mean that China's not a very well-regarded trading partner. I mean, their money's, really important to a growing, developing economy like Namibia. Now, to your point in uranium specifically, yes, they have. I mean, China's appetite for uranium is absolutely voracious and they like operating in Namibia. They did a takeover of Extract Resources in 2012 after Fukushima. They took that company over for 2.4 billion and have spent another 2 to 3 billion building the Husab mine. They bought Rio Tinto's majority interest in Rossing uranium mine a couple of years ago. They own a 25% interest in the Langer Heinrich uranium mine that Paladin Energy owns. And Namibia is an ideal investment proposition for China because they need the pounds. They produce very little domestically despite huge exploration campaigns. And Namibia and Niger are the only significant uranium producing countries in the world where China can invest in that way. There's a Foreign Investment Review Board that's blocking Chinese investment in Australia. In Canada, Chinese companies can't own, or foreign companies can't own more than 49% of a uranium mine. Chinese investment's been blocked in the US. In Kazakhstan, by law, Kazatomprom has to be the dominant partner in any joint venture. So if China wants to control and own their uranium mines that they're producing from, they have to go to Namibia and Niger or start something fresh in a brand new country. And that's got a few challenges to it.
All right, great. Yeah, I think it's actually exciting that China wants to put its capital in Namibia and protect it. So I think being in that jurisdiction is probably business friendly, right? If China's happy with it. So let's see. I know the metric is like the value of your company on a per pound basis. Sometimes it can be like way below spot, but is your company fairly valued, you would say, around, I think the market cap is something around 373 million. Is there a lot of room to grow from here?
Yeah, enterprise value to resource pound it's a fascinating metric. It's useful and it's got some huge limitations. So for investor folk out there, I'd always treat it with caution, but don't ignore it. And I'll tell you why in a moment. So in terms of some of the cautionary aspects of enterprise value per resource pound, and I offer this in the knowledge for everyone out there that we are amongst the very, very cheapest. So in a sense, I'm talking against my own book here, but it's better that people understand their limitations. So first of all, they're a thumb suck. They're a rule of thumb, and they shouldn't be regarded any differently to that. A resource pound that can be brought out of the ground in 2025, like we expect to be able to, should be a lot more valuable than a resource pound that is maybe 2030 or even longer.
Right.
Resource pounds have different qualities about them. They have different technical risk. They have different financial risk and economic attached to them. So there's many different factors. And then the other thing that's really key is quite often when I see those comparative tables, there are companies who have resource pounds that are somewhat distributed amongst different projects. And I would advocate for greater value where resource pounds are all in the one mine or all in the one vicinity. In our case, as I say, 208 million pounds are at Atanga, and then we've got roughly another 60 or 70 million pounds in satellite deposits that could be trucked to the main mine. Now, having said all of that, and with investors out there doing their own research and taking on those disclaimers, EV per pound is a fascinating metric to watch right now in the market. And I'll tell you why. So during those days when there was plenty of uranium, there was an excess supply, prices were going down rather than up. The utilities and other players in this sector, their attitude was, there is so much uranium above the ground that the world doesn't need right now. Why would we put any value on stuff that hasn't even been dug up yet?
Right.
You get it, right? Now we're in the total opposite of that. So now it's like, where's all that uranium above the ground gone? It's gone, being held tight by utilities who figure they're going to need it in the next couple of years, or it's being hoovered up as we speak by Sput, or you've got traders scrambling for it to close out deals that they've already committed to. So all of a sudden, in months, we've gone from a position of, why would you bother wondering what's under the ground, to that's where the next flow is going to come from. That's where the pounds are going to have to be. And when you've got scarcity above ground, the market will start to value what's beneath the ground. And then all of the attributes of a company like Bannerman come in, and you say, well, they're proximate to production. They're producible pounds because they've got the environmental approval. They're in Namibia. They've got all of the government and social support. So these are not pounds that might end up being stranded. These are pounds that will come out of the ground. So they should have a premium for that reason. They're all in the one place. They're all attached to the one mine that is attractive to both end users, but also investors. So they should have a premium for that reason. It's very conventional. It's very simple. We've run a pilot plant. So both customers and investors and financiers aren't going to be scratching their head going, gee, is this thing really going to work? That should attach a premium. So therefore, I think that's a metric that should definitely come into the calculation of investors when they're trying to judge what is a really difficult proposition right now, which is all uranium companies have risen with this tide. And it's so hard for investors now to pick, well, which company is going to keep going, which ones are going to fall back, which ones are going to stumble, who's going to get locked up because of a jurisdictional issue, community angst, who's an explorer who's not actually going to find anything and going to sort of fall right off. This is really tough times for investors right now. And that's a metric that I think is very helpful. And we, as you can gather, I think we screen very, very cheap, and we'll expect a re-rate because of that.
Thank you so much for your time. That was really exciting. Great information. Where can people go to learn more? And if you have anything else to add, please do.
Yeah, great. So Bannerman Energy's website, bannermanenergy.com, has got some great information about us, of course, but also about nuclear power and uranium. So that's a good starting place. I'm quite active on Twitter, Brandon_Munro, MUNRO. And we've got a great Twitter uranium community that's really supportive, provides great quality information. And so you can plug into that, and I think you'll find that to be really useful. Bannerman Energy's got a very good Twitter account, which is positioning different information to what I provide. So it's worth giving that a follow as well. And that's probably the best place to start. That's covering off those couple of things, and you'll need to know what you need to about the sector. I also publish articles from time to time, but you'll pick those up from Twitter.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.